Our next guest says the market already priced in a mild recession. For more on the Fed's decision, let's bring in Sharmin Mossavar-Rahmani, head of the investment strategy group at Goldman Sachs. He's also Goldman's chief investment officer for consumer wealth and wealth management. And Sharmin, it's good to see you. I was just distracted as I entered you, just listening to that thought, because if we want to eventually impact demand, Jay Powell to say, wow, things are really strong in the labor market. By saying that, it almost sounds like, things are so strong, we got a lot more work to do. I think he's saying it in a way to allay our fears about an imminent recession. But if that's the only tool the Fed has to try to bring down inflation, then saying it's going to be really tough to cause a recession just means he's got to go further. There's a lot of pluses and minuses and nuance to all of this. How did you see that comment?
When we think of the market and the 1.5% or so rough rally yesterday, we like to remind our clients that it was not just driven by the Fed, by Chairman Powell's statements and press conference. If you think about the rally, it started in mid-June. So the trough of this current rally was in mid-June. So we've had about 6 weeks of price appreciation. If you think about when bond yields, the 10-year peaked roughly at 3.5%, down to about 2.78. That also happened in mid-June. So from our perspective, there was just so much negative sentiment priced in the market that when we look at surveys, when you look at investor positioning, you look at their pessimism, the small amount of risk that anybody was taking, actually worse than what we saw during Lehman in the global financial crisis. Typically, when you have a 20+% downdraft, and this time our downdraft was high to low 24%, after about 6 months to 12 months, you end up with the market generally being higher, on average higher by about 12%. And if inflation has peaked, as is our base case, typically the market also rallies after that. So if the last CPI and core CPI prints we got were the peak, then chances are the market is going to be about 10 to 12% higher. So our recommendation to our clients is to focus on the big picture and stay invested at this time, with some tactical tilts here and there, for example, in the energy sector.
Makes a lot of sense, Sharmin. And you're not in the majority right now, I can tell you, right, because we have a lot of people on looking for new lows again and again and again. And we've brought up the June 16th low, which was where we saw it. We did not see the capitulation or the VIX soaring to 38 or 39 that a lot of people are looking for. And many people are hanging their hat on that we haven't made a permanent bottom. Do you think we made a permanent bottom? They think this is an intermediate rally in a long-term bear that's going to take us to new lows. Do you think we've seen the lows?
If we typically look at market downdrafts, if there is a recession, the average or the median, when you look at the numbers, are between 25 and 30%, looking at all recessions since World War II. So when we think about a down 24%, is there a chance the market goes down another 5% from those lows? So let's say 10% from current levels. For sure, there's some probability. We also have to recognize that there is some probability that's not insignificant of a recession, not necessarily just because of the moves by the Fed, but because of the incredible tightening of financial conditions. Our team in Goldman Sachs' Economics Research Group have a Goldman Sachs Financial Conditions Index. It looks at the equity market. It looks at the incredible strength of the dollar. It looks at changes in Fed funds, but also changes, for example, in the 10-year and in the spreads of the corporate market. Financial conditions tightened by 3%. That is roughly, very approximately, equal to the Fed tightening by 3%. And that slows down GDP in the future by about 3%. So if, for example, this year, without the Fed tightening and without the shock from the Russian invasion of Ukraine, growth was going to be around 4, one would say, okay, maybe growth will be around 1 1%, a little bit higher, a little bit lower. We don't know what the GDP print will be. But the reality is, as Chairman Powell said, the underlying conditions are actually quite strong. There are pockets of weaknesses, but there are also pockets of incredible strength. And so in aggregate, if we have a recession sometime in the next 12 months, the market will be lower. But it's not a given that we're going to have a recession, especially since financial conditions did a lot of heavy lifting for the Federal Reserve, in fact.